Hello, this is Anne. In this video, I'm going to share with you how to manage risk in trading. I have created a demo account for this purpose, but since today is still Sunday and the Forex market is still closed, so I'm going to use Ethereum as an example on how it works because they are open 24/7. So anyway, in the Telegram groups, I noticed several people are using the same lot sizes for every single trade they entered. For example, they're having $10,000 capital, demo or live, and they decide I'm going to use one lot. So they always enter a trade either for gold, cryptocurrency, or Forex, whatever asset they choose, and it's always one lot. And that is so wrong, and I'm going to show it to you. I'm not going to count the pips here, okay, for easy calculation. I just want to show it to you how trading using the same lot size for every single trade is wrong. Okay, so let's say this is your trade. So this is your entry and this is your stop loss. For example, if the market against you, you will lose $100. And then if you win $200. And at some point, if you change the time frame, or let's say you still trade the same pair, and your stop loss becomes smaller like this, and because you use the same lot size, let's say now if you hit the stop loss, it will become 50 instead of 100. And then if you win 100 instead of 200. So when you use the same lot size for every single trade, that will make the end result of every single trade different outcome, because it will always calculate the distance, the stop loss pips to your lot size, and that is not a good way to manage risk in trading. And another thing that people always use, that is risking based on X percentage from their capital. You're probably one of them who used this technique, and I'm gonna show it to you why it's not good for your account in the long term. Let's say your starting capital is 1,000 and you decided to risk 1%. That means your risk 1% from 1,000 is $10. You know that the market ups and down, and sometimes you have a bad weeks or months. Now, let's say you're losing 10% from your capital and your capital become 900. So you're risking 1% is no more become $10, now become $9. And then you are facing another bad month and your capital from 1,000 becomes 600. And your risk 1% become a lot lower, that is $6. As you can see, when you're losing trade and always risk the same X percentage for current balance or equity, it's gonna be more difficult for you when you want to fix it and go back to this level. Because the difference is quite big, almost half of it. So meaning you need double effort to come back here. So to me, this is not a good risk management for trading. I'm gonna show it to you a better way to manage your risk in trading. I have been using dollar amount to risk for every X capital and compounding. How does it work? Let's say your starting capital is 1,000. The first thing you have to do is to ask yourself a question. How much are you willing to lose per trade from your starting capital? Are you willing to lose probably $1, $5, $10, $20? Use dollar amount, not percentage. So let's say you are willing to lose $10 per trade, regardless any pairs, time frame, or stop loss pips. Imagine the worst case scenario for maximum losing in a row that may happen to you. Let's say you think probably 10. If I lose 10 trades in a row, that will cost me $100 losses. Am I gonna be fine? If you're gonna be fine, then losing $10 per trade is the way to go for you. But if that will make you feel nervous, so you need to lower your risk amount per trade. I personally willing to lose $5 for every 1,000. You probably different. Usually, the bigger the capital, you will want to make your losing per trade smaller. This is in terms of percentage, it's the same like 2%. But the calculation using this dollar amount will be different than X percentage, and you will see, okay? So, the first step, you know your capital, and then you have to ask yourself a question. How much am I willing to lose per trade from this capital? because that will become your commitment on how much you are willing to lose per trade. And don't forget to always imagine the worst case scenario, that if you lose a certain amount from your capital, you will still be okay. That will not upset you. That will not make you nervous. Like myself, if I lose, for example, 10 in a row, meaning I'm gonna lose 5% and I'm still okay. If that still make me nervous, maybe I will lower it to become $4 per trade or $3 per trade. Now, how does the amount risk per capital compounding work? Remember, you already asked yourself a question and you got the answer. For example, your starting capital is 1,000 and you are willing to risk per trade $10. You got to know ahead of time before you enter a trade that you know if you hit the stop loss, you will only tolerate a trade to take $10 from your capital. And then when your capital reaches 2,000, then your risk per trade become $20. And also when your capital starting 3,000, your risk per trade become $30. So it will be compounding. When your commitment is always $10, not based on risk percentage, it will be easier for you to fix a losing trade. Which means when your capital become less than 1,000 and up to 1,999, your risk per trade should always be $10. Now, once your capital reaches 2,000 and up to 2,999, your risk per trade will become $20. And then when your capital becomes 3,000 and then up to 3,999, your risk per trade become $30. Regardless pairs, time frames, and stop loss pips, you know ahead of time that this is the amount I'm willing to lose per trade. And that way, it will make you feel comfortable when you enter a trade because you already know the amount that you are going to lose or win ahead of time. And this is a very good risk management in trading. All right. Now, I'm going to show it to you how it works. And obviously, this is going to need some kind of tools to calculate the compounding. So I have been using this tool. You probably use different tool. As long as it follows the guidance in here, you are good to go. Okay? All right. Now, I'm going to show it to you how it works. Here in the software, I choose the lot size management dollar amount. And maximum amount you are willing to lose per trade is 5 meaning $5, okay? For every equity compounding 1,000. So this is my base. So right now here in the demo account, the capital is 10,000. So when I enter a trade, meaning if I hit a stop loss, it will be no more than $50, right? Because it's 10 times of 1,000, meaning it will be 10 times of the dollar amount I put here. All right. And here the risk reward is 5 because that is the minimum amount I always aim using the order block. But let's see how it works. Okay. So now this is Ethereum. Okay. Let's say I want to put the pending sell over here in the same area. Okay. Now take a look. I click pending sell and I adjust my stop loss, and then I put where I want the price to start selling. This is not exactly a strategy. I'm just doing it for the sake of example to show you how I manage my risk. Okay. Now I click send order. Okay. Now if you see, this is already 1 to 5 because I set it up risk reward 5. But that one is, it doesn't matter. I just want to show it to you. Take a look at this. Can you see that? Profit minus 50. Because I tell the software that I am willing to lose only $50. Okay? Now, the lot size, let me see. What is the lot size? 0.56. Alright? So now, for example, what about if I put the stop loss here and I want to start selling here? All right, the same level but different stop loss, and click send order. Now here is become, I think, 86. Let me see. You see, one pending order having 0.86 and the other one 0.56 lot size. Now take a look here. Look, almost 50. So every single trade I entered, regardless the distance of the stop loss or the pairs or the time frame, for every single trade I entered, I know I will only lose 50 bucks. Okay? So here I'm going to show it to you again example. I'm sorry I cannot move to another pairs because the market still closed, but you will see, like if I go for example to M5, that's why if I want to snipe, for example, let's say this is my order block, okay, just for the sake of example, so this is my order block, so I will put pending buy, for example, in here. So I want to snipe. Okay, I'm not talking about a strategy here. I just want to show it to you how it works in terms of money management. And then I decided here, click. Okay, now take a look. 49.88. Every single trade on H1 to M5, it will always give me 50 bucks when I lose a trade. And then it will always give me, like, if 1 to 5 is almost like 250, right? In this case, 249. Now take a look. The size, before it was 0.56, now because I'm going to lower time frame, so obviously we will have higher lot, but if it lose or if it's against me, it doesn't matter, it will still end up $50. So this is the way how you will want to manage your risk per trade. You know ahead of time how much are you going to lose, okay? So regardless you're using the same tool like me or not, it doesn't matter. But the most important thing, you know how to manage your risk in trading. Alright? Also, as much as I want to share this tool with you for free, but this is not belong to me. So this is belong to my husband. And the fact I know that he spent almost $9,000 for over 5 years to keep upgrading the software. So if you want to get this tool, you can go ahead to the website here. Oh, he put the rent here. Yeah, you can try this like for 3 months for 30 bucks. You tried it if you really want to start managing your risk the right way like this. Or if you already have another money management tool, you go ahead use it. I just want to show it to you the right way how to manage risk for your trading. Alright, so I think that is all for now. Thank you. Bye-bye.